to start?
Hi, Ragu, Nihar here. Sorry, I couldn't talk earlier. I'm just in the cab right now.
Sure.
So, thank you so much for taking out the time and being here and taking the session for all of our members. So, I would just love to thank you on that note. I'm sure it'll be very insightful. And I do not have anything in specific. I'm just here to observe and learn from you. Yeah, thank you.
Great. Can we start? Yeah. I think she's still on the call. Chandrika.
I think we can start. No, she's recording.
Can start? Yeah, great. So thanks everyone for joining. As you all know, my name is Ragu. I am doing this session on 3 backgrounds. Primarily, one of the practice I personally do is write family constitution, wherein the follow-on is structures for family wealth protection. That's one. I've been involved with it for several years in the past in multi-jurisdictions. The second experience is settling family disputes. I've been intermediary for several divisions, subdivisions, which also involves sometimes some structures to take care that the BQ thing happens in the right manner. Unfortunate stuff I am currently involved in too. That's a second experience. Sometimes structures creates a lot of complications when you are to do division. We are settling in one where we have how many companies? About 20, 30 companies? 30 yeah, 30 plus companies in various shareholdings. We have to do a lot of complications to do subdivide between brothers. So sometimes structures help us. We have to also anticipate that the future may not be the same as what we are. So that's a second experience. The third experience is primarily we are an audit firm. We do tax and consulting for high net worth individuals and corporates. So obviously structures both from the corporate angle, from an individual angle, it works. So that's a third experience. And primarily I'm a management consultant of 40 years experience. That's the background. I've been part of several restructurings and other things. So let's come to the topic today. We'll click on the topic very specifically. We have a small presentation to share. We are not going to restrict the presentation. I also noted a few points what came in, but we'll go by, I'll try to cover as much as possible, but you can feel free to ask me any questions, and I suppose we should be able to answer them. So family trust, primarily why today we're talking about family trust? That's the first question. I mean, why are not that created family trust? See, if you look the Western countries, trust is very common, because what happens is they all made money. Wealth was made much earlier. Today we are making wealth in this country. They made wealth much earlier, and they all figured out how wealth should flow from one to the other. If you look at even a simple example, let's say my father died about 2 years back. I'm still going through change in some of the assets he had. He had very little assets, but even then I'm going through the pain of change still. So I had to go to now the court, get a probate, go through the process. Even though my brother and I are the 2 legal heirs, but still I have to prove that we are the only 2 legal heirs. Is that right? So that's a challenge we go through. So there are a lot of procedural aspects when you have to bequeath property from one generation to next. Be it a movable asset or an immovable asset, whatever it is. You have to go through a registration process if it's a immovable asset. Even if it is bequeathed through a will, your ownership is certain, but recording of that ownership as a process and a time involved, and maybe a cost involved. And could be a potential dispute involved, which we are not forgetting. Is that right? So a third party could jump in and say, this is mine. Because there is some recognition that who is the owner, somebody is trying to take advantage of that situation. So in order to bring certainty to all this process, what could be a vehicle which never changes the name or never changes the structure when generation change? If you put that question as a simple question, you get an answer that, okay, let's hold all in one structure, which does not change hands, which is permanently there, whether my son, my grandson, my great-grandson, or whatever generations I get, it is there. So that is how the trust structure came in. And secondly, why trust structure came in? Certain countries have an inheritance tax. What is inheritance tax? Inheritance is not by generation. Whenever there is a change in the title owner of a property, there is likelihood of a tax. We pay tax when we sell a property, capital gains tax comes in. So in order to avoid that, they form trust. Second, so that the trust is a vehicle which is permanently there. The third reason they form trust is not to have a third party claiming the property. What happens in a trust? There are beneficiaries clearly defined, so that there is no confusion, and they don't want people to include other than the family members. So when you define an author defines a trust, that is when a trust is created, it is created by an author who is the originator of the trust, is known as author. His ideas are supreme. So long he's alive, he's the only person who can change those ideas. After his death, it is mostly the registrar or the court which will change that directions. So once you write the legal ascendants of the family members, no third party can come in. Is that right? In a company, if you hold the property, somebody can walk in, get into a directorship, do all this. Is that right? That's the reason. So the trust is more like a permanent vehicle it came in, and that's how the family trust started. There are also business trust. You'll be shocked and surprised. Lawrence and Mayo, a company which is very popularly operates, is run by a business trust. That company is incorporated pre-British. It is incorporated, I think, in 1817 or 1819. Such an old company it is, Lawrence and Mayo.
They're a member of CorporateConnections.
Yeah, so Bombay. One of the brothers stays here, no, Hyderabad. They have 4 brothers, cousins, they operate. You go and ask them which year they're incorporated, he will tell you. Their business is run by a business trust. So the profit goes into your trust. The trust is the owner of the business. So sometimes even business people create a trust. Then what happens? It's easy that beneficiaries are known. It is not going out anywhere. The trust has a very set rules, very defined rules, and you can't break those rules. So that's the first reason why a trust came in. If you look at this trust has got, let me also define the structure of a trust so that we get it. There is a person who creates a trust. He is known as author. Generally, a trust is created with small amount. Somebody will create a trust with 10,000 rupees because there is a stamp duty. So trust has got a peculiar structure where if you put too much assets, you pay large of stamp duty. So people create a trust with 5,000, 10,000 or 1 lakh. That's all they do. You create a trust. He's known as author. He defines what the trust objectives are, who are the beneficiaries of the trust. All these are defined. So like supposing I want to create, Venu wants to create a trust, let's say. I can create a trust on behalf of Venu, put this 1 lakh and say this trust is for the benefit of Venu and his family.
So you are the author?
I am the author, but I am writing it. So generally trust is created by self or by mother or somebody on behalf of the children or the father. Generally that is done. Or the elder brother will create for the younger brother like that. But you can also self-create. Venu can create a trust by himself, putting in 10,000 money and slowly add assets of his into the trust. That is known as author. Beneficiaries are the people who are entitled for the benefits of the trust. You can be beneficiary, you can be author, you can be a beneficiary by yourself also. Your family members can be beneficiary. You could also define others as beneficiary depending on that. Or you can define 5% for charity. A lot of secured trust. I did a trust for a doctor in the US who used to perform very high liability operations in the US. He was a multi-billionaire. So we have to secure his trust because of medical legal liability, where he had 25% to be given to charity as one of the beneficiaries. And if you put minor and charity as beneficiaries, you get a little security on the trust. Because to the extent, and also there are countries, India it doesn't have, you look at several countries where when you hold property in the trust, after a lapse of certain years, 7 years, 9 years, 11 years, the property becomes completely secured from any third party claim. So structure, Bermuda has got a structure, Singapore has got a structure, New Zealand has got a structure like that. You should not have done any defrauding while creating that trust. You should not have had liabilities. Once you do it, after a lapse of the time, it becomes a secure trust. So such structure also gives you security very clearly. So that's the reason why these trust structures came in. Beneficiaries are the people who are entitled to the benefits of the trust. Trustees are the people who govern the trust. They're like board of directors. Author can be a trustee, author can nominate trustees. Trustees are generally like Tata Trust if you take. It's run by professionals, is that right? They're nominated, they create criteria who can be a trustee in the Tata Trust. They got a good and sound person criteria for Tata Trust. They qualify every person. Are you fitting to this criteria? Okay, you are qualified to become a trustee. So people can create criteria for that as a trustee. There is one more concept known as protector, which is generally not used in India, but can be used in India. Nothing wrong that you can't use it. A protector is a person who protects the object and the intent of the trust which the author has created and directs the trustees whenever they exceed that intent or the objective. Direct the trustees, boss, you can't exceed. I am warning you. He is to protect the trust for the object and purpose for which it was established. Generally, in the Indian context, when you write a trust, they don't put a protector, but there's nothing wrong to put a protector. Unfortunately, that knowledge is not there. When we were doing our AIF trust, I wanted a protector, but the law firm, one of the prominent law firms said, no, sir, let's not put it. It's difficult for you to register. I was interested in putting it. So that's how the system is, but there's nothing wrong in putting it. A lot of times they put people who are well versed with trust provisions, people who are do family constitutions, or legal professionals who are well versed with settling disputes, or people who are in the mediation roles. They put them as protectors, so that the objective of any trust is that there are no disputes. Whatever it is, you amicably settle. That's the objective. So that's why they put those people. These are the 4 broad functionaries in a trust. There's an author, there is beneficiary, there are trustees, there are protectors. Very clear. So another point I want to give in trust is, trust can also have sub-trust. One trust can be a beneficiary in another trust. There are possible. A lot of family trusts are made in such a way. There is a mother trust, and there are business trusts. There are family trusts within that. There is a mother trust. There are 3 brothers. A lot of in the community, business community from Rajasthan, they all create mother trust, and 3 brothers will join family. 3 sub-trusts will be there. Clearly. So those kind of things are also will be there, because each of them may have their separate income gains, which will go into their trust. They also become part of the main trust. The mother trust will have all the business under it. Individual trust will be beneficiary, as well as even individually sons below that also may have separate trust again. So it could be a web of trust possible.
Family tree.
Family tree possible. Generally, what happens is 3 generations will be there. Okay. After that, people very hardly they survive. So generally, some trust will get dissolved, and then other trust will come in, kind of a thing. Or you collapse one trust, merge one trust, kind of a thing.
Just to understand this slightly better for myself. So if there's so let's assume there are 2 or 3.
Sorry to tell you, can ask questions any point of time. Please feel free to ask.
We'll always ask questions.
Yeah. I'm telling you, people in the Zoom also. Yeah.
So if there are, let's assume there are 3 or 4 siblings. So when you make multiple trusts, is it also where you have a family trust where money or wealth is given to them, all of them together? But there's a very good probability of one of the siblings doing better than the other sibling. So is there a further trust that gets built? Is that the reason why you have other trust? Because you're protecting whatever income that you might generate from your activities as compared to your siblings? Or
see, that's a family proposition. I told you I talked about family constitution. Some families provide for equality irrespective of
how the
other businesses.
Yes.
So that the main principal reason for that is inequality breeds problems. Equality does not breed problem. and equality does not bestow competition. I want to beat my cousin. I want to do better than my brother. So once you have equality, all of you work together. So that is one principle. But the other principle is, if somebody is very dynamic, other person is not dynamic, equating them, some people feel that it is not good. So some trust, some families decide otherwise.
So just trying to understand, why do you have other trusts in place instead of just one big trust?
The other
Why
trust
there
is,
a need for-
this is also sometimes to protect liabilities. What happens is, as a business, we enter into multiple business. Sometimes you take huge liabilities. So we don't want all the liabilities to be. First of all, when you do family trust, one of the basic we do is we never deal with any outsiders in the family trust, so that nobody will be able to sue the family trust. There's always one Chinese wall, another entity which deals with outside world. There is this is my family trust that never deals with outside. The only check the family trust will write is to distribute to their beneficiary. It will not do anything else. It will not write a check outside. It will only write a check to this other entity. It will never write. Even to auditors, it will not write. It will not have any outside dealings at all. That's the best way to insulate a family trust. So the trustees, in fact, if you go abroad, even in India, it is becoming popular. Indian Trust Act, the trustees are unlimited liability. The unlimited liability is to the extent of the assets of the trust. But what happens is, in book value, I might have 100 crore as value, but then market value of the trust could be of 1,000 crore. Then it extends up to 1,000 crores. If the trustee has done any modified intention is acted, it can even go up to his personal property. He has done it some defrauding, or it can be proved that even his personal property is attacked. That's why I sit in a mutual fund as a trustee. Mutual funds are trust in this country, but the trustee is a company, and I'm a director in the company. That's why I'm a trustee. It's a very regulated mutual fund. So my liability is limited because it's a company. Is that right? Otherwise, I can't expose myself for a private mutual fund, for a public mutual fund where I don't have interest. I can expose my private property. So a trustee is always created as a company. But a lot of times, people don't do it. Most of the 99% of the trust in India are on individual names. But now the trend is to create the trustee company is coming in. So in order to answer your point, there are mother trust, there are individual trust. Sometimes when each of them, like if you look at, I can give you an example of JSW Steel. The structure of that family is the mother owns 25% in all these three companies. There are three brothers, Sachin Jindal, Ratan Jindal, and Naveen Jindal. Is that right? Mother is that Savitri Jindal, who recently won as an independent. She owns 25% in each of these companies. Each of the brother owns 20% in each of the other brother companies. To take JSW, Sachin Jindal, who is running the company, owns 25%. Savitri Jindal owns 25%. Naveen Jindal owns 25%. Ratan Jindal owns 25%. Now, each of the business, as Naveen Jindal runs stainless steel, Jindal stainless steel. Sorry, Ratan Jindal runs Jindal stainless steel. Naveen Jindal runs other businesses. So each of the business has different risk profile. That right? So they all also have their own family trust. There are many reasons. There's no one single reason. When we structure trust, we understand the family dynamics, we understand the business risk, we understand the longevity of the business, and then structure trust. I don't think there's a single bullet answer saying that if this is what it is, create a trust. It's very, very dynamic. A lot of times, a lot of families don't have multiple trusts, they have only single trust.
No, this is completely different from an HUA.
Yeah.
Is there a reason why people prefer doing that?
See, HUF was a concept originally evolved more as a tax saving device. You got one more exemption, that's all. It's not a structure for BQT. Trust is a organized structure for BQT.
Yeah, let's say I move a property into a trust. And now you said once you have a property in the trust, it's ring fenced. Right? But somebody is litigating the right. So then, let's say I put a property into a trust. The day I put a property into the trust, there is no problem. I received it from my family and my ancestors. As on date I put it into the trust, there is no litigation with it. Tomorrow somebody wants to litigate it, they can do it. Right?
Yes.
So even though it's in a trust, it can still be.
Yeah. So I will not say that once you put the property under it is ring fenced.
Okay.
I will also give you an example. In Hyderabad, one of the case was owning a hotel property. He had a property which he had pledged to the bank. But for unfortunate reasons, he had guaranteed, he was personal guaranteed, not pledged, personal guaranteed, and his house was on his personal name. So at some point, this happened a long time back, not yesterday. At some point he came to me and said, why don't you put your house into a trust and put your grandchildren as beneficiary? He quietly did it. And after 7 years, his account went into NPA. His house got protected.
Okay.
There is a ring fencing. Because by the time in fact, it was so lucky when the case was filed, the children were just 16 years old. They're still not 18, luckily. So that he could save his home. There it got ring fenced.
Okay. So something that you are buying which is clean and you put in, if you inherit it, it comes with the litigation that happens.
Not that by putting in trust you are securing your properties. That's not the case.
Right. No, as of today, I have no problem, but that's one more.
So here in this case, he would have, even if you would have gifted the same to not putting it in a trust, if you would have gifted the property house to his grandchildren, it would have had the same effect.
It would have had the same effect. But then, since we provide for a permanent solution, I told him that you put the permanent solution because again, when his grandchildren after 40 years will be into the same problem, is that right? so you always trust we are looking at as a permanent solution, is that right? For generations, it is like that. A TVS family has got a trust. It's been there for 70 years now. Is that right? That's advantage.
So once we move a property into the trust, we cannot move it out.
You can.
The main
You
author
can dissolve the trust. You can dissolve the trust. Always a possibility.
It's on the mutual consent of everybody.
Yeah, you can dissolve.
So when a property comes in or goes out of the trust,
all family dispute, trust has to get dissolved or trust has to get distributed. There's no choice. Is that right? That's what happens.
trust is treated as a different entity. So when the property moves in or out of the trust, so there is a stamp duty involved.
We will come to those. We'll come to that. Those points we'll address. So why trust? It avoids a probate because I told you my father had a small assets, but I had to go through a process of getting this probate. So it avoids a probate. You create a permanency irrespective of what happens. Untimely demise or planned life, everything you can taking care of. That's one advantage. Then family disputes. Everybody knows what they are getting. Everybody knows their claim. So Vineet asked me a question about discretionary trust. So there are two types of trust. These family disputes, I will come in specifically, it comes for that point. See, you can define a trust and say each of my family members are eligible for 20%. There are, let's say 4 people are there. Each of them is eligible 25, 25, 25, you can say. Or you can say somebody is eligible for 35, somebody is eligible for 10, somebody is eligible for 45, somebody is eligible for 5, you can say that choice is yours. Or you don't say that these are the beneficiaries, but I'm not disclosing what are the interests they have. Most trusts abroad are discretionary trusts. If you look at Warren Buffett Trust, his son Howard Buffett, until last year, he didn't know that what he is going to get. Finally, his father told him you're going to get 4 billion. In that also, he's put a condition that 2 billion you have to put in a Howard Buffett Trust. You should do charity. So I did a trust in New Zealand where he had 2 sons. So he was not sure that his son should be loyal to him until his lifetime. He created a discretionary trust so that the sons do not know what they are going to get. So most times you create a discretionary trust when you want to keep everybody guessing and binding. That is one of the reasons. Second reason is, I forgot your name. So he asked a question about how do you differentiate between somebody doing well and somebody not doing well. If father feels that, let me keep it discretionary, one person is creating 90% wealth, other person is only spoiling the wealth, why should I give it to him? Then also you can create discretionary trust. It's always wise at that point of time because you always create. See, while I said equality among siblings is good, but at what cost? That also you have to think.
Social aspect.
Yeah. So that point of time, a lot of times people don't disclose. When you create a discretionary trust, what you do, you only disclose what you want to give in the will. So that when a will is opened, that is known. Other than that, nobody knows it. There is one witness to the will, he knows. And there generally be two witnesses to the will. Generally, an accountant and a lawyer will be witness to the will. Most cases, that is a common structure. Even they will know. And after death, the will is registered. After death, the will is read where people will get to know. Sometimes, when the father, who has a highly charitable mind, wants to ensure that a lot of property is given to a charity, which the sons are not agreeing. I had a case where in Vijayawada, I was doing a family arrangement, where the father is highly charitable in nature. Sons were very worried. They always tell me, no, father will give off the temple. Please tell him, please tell him. But I told father, sir, you please get a discretionary trust. Don't get a fixed trust. Because, I want to also, because if they come to know today, they'll fight with him. Until his end of life, let him live peacefully. Let them keep guessing. And then let it unfold after his life is over. It doesn't matter, Then they can only blame him. They can't trouble him. Is that right? So that's the story. So discretionary trusts are done for various reasons where you want to keep the proportions. Also, when you want to variate the proportion. And supposing I got 4 sons, I don't want to give 25, 25, 25, 25. But I have to see them every day. Is that right? That's one of the reasons. Then I'll create a discretionary trust, I'll put it in my will. They will get to know only after my death. Let them blame me. But before we are there, they're all very well. I keep telling them, don't worry, I've done justice to all of you. I make the statement. That's fine. So that's a cases where discretionary trusts are done. But discretionary trusts are taxed at the trust level. And beneficiaries, there are beneficiaries, defined beneficiaries, they're taxed at the beneficiary level. So there are some changes in the tax structure of the beneficiary. They are taxed a little extra, but sometimes you're okay to pay extra tax because you have to buy peace at home. Is that right? And you have to see everybody's face. The son you have to see, the daughter-in-law you have to see. So it's impossible for you to live in the family and live in the circles for years. So you do that. You sacrifice all this sometimes.
Apart from the author, does anybody else know about the what is written for a discretionary trust, like a protector or something? Do they know?
Yeah, it's author's choice. Like I am.
The beneficiaries will not have.
So in the New Zealand trust, I am one of the witness to the will. And the will is revised every 1st January, depending on the behavior of the sons. so you can imagine, it's so complex. Is that right? So complex it is. So every time I go to New Zealand, I go and sign as a witness because I'm not there always. The other person is New Zealander who's a lawyer. So I go and sign every time. Yeah. But I got an oath of secrecy with him that I will not disclose. Is that right? That's how it is. And you have asset protection I talked about, sometime in trust you can do. If you are supposing, you also put a charity, put some legal obligation, put some control on that, you can protect. And there are various ways to do asset protection, but not so prevalent in India. You can't do some mass fraud and still protect. That's not possible. But genuinely you can protect. See, Indian, I told you this case of Hyderabad where you put the property in the trust. When you do a personal guarantee in India, you are guaranteeing on the assets what you have got in case the main security is inadequate for repayment. But no guarantee agreement forbids you to transfer or not to sell your assets. You're supposed to go and take permission from the bank. Sometimes that clause will be there, sometimes that clause will be absent. Okay? And you every day sell something, some small car you buy, the personal car you buy, you sell. You're not going to go to the bank and ask, sir, I'm buying one car, I'm selling, please give me permission. Is that right? You do that, the normal course. Even movable assets are covered when your personal guarantee. Some jewelry you buy, some jewelry you sell. It happens. And you don't want permission. Similar way, when you sell a house also, you don't go to take permission. So sometimes asset protection can be done this way. Ownership is permanent. You don't need to worry about it. And distribution of income earned without double taxation. Generally, a trust structure when we make in such a way that you don't pay two taxes. We will come to that. Hello?
Did you log in?
Yeah. Okay.
So
is there any questions from the video audience? Okay, I'll go on further. We'll take the Q&A probably at the end.
I have a quick question here. So ownership is permanent even through generations, right? Once the author has passed away, then who becomes the author of the trust? There is no longer an author.
There's only one author for that.
There is only one author for the trust.
That's all. Kirtna and I are dealing with a trust which is 100 years old. 100 years old.
So generally,
it's a charitable trust.
Okay.
It's running an eye hospital in Delhi. Very popular. What is the brand name? Shrop's Charity is known as. The author died. Now we want to amend the trust because 100 years trust, and today they have grown. They are like LVPI in Delhi, and they want to do so many things. There's nothing like written like research, nothing written like only patient care is written, nothing else is written. So now we have to go to the court. We are now going through the process to amend the trust for modern and futuristic outlook. Is that right? So we have to go through this now. We have to go to the court because the author is the only person who is there. And after that, sons are there, but they are only sons. They are not the author. They are not authority to change. All old trusts have this problem.
So in a new trust, if you're forming a new trust, can you put in a...
Yeah, you can put in, we are now putting in a condition in that trust saying that any change in objects, which is unanimously approved by the trustees, which is further confirmed by an independent lawyer, further confirmed by an independent chartered accountant, can be processed by the registrar of trust on request. We're putting safeguards. Trustees are unanimous. And there is two safeguards we are putting so that somebody does not hijack it. So you can put safeguards, your own safeguards like that in the trust. This I think you already covered almost like. I will skip this slide, but I'll come back to certain aspects of the trust. Yeah. Legend, I think we can forget it. This no problem. Yeah. So this is all the family members will form a family trust with each member designated as a beneficiary in the main family trust. Okay. Generally, we make all family members. Sometimes there could be division within the family before even a family trust is. I am now dealing with a situation in Hyderabad where 5 brothers are there. 4 brothers stayed together. They've always stayed together. Mother is there. Father is no more. One brother got separated long before with property also separated. One of the brother is a government servant. No property is on his name. His property is held by mother. Other brothers have equal share. I'm now creating a trust. So I want to insulate the brother who is not having a property for him to get the property when he finishes his term. I don't want the brother who's separated not to be encroaching and making a claim on this property where he got separated and he was paid. And I want all of them to be not having any problem in terms of distribution of assets. So when you make trust, I don't make certain people as beneficiaries for some time. They can bring, the mother will be a beneficiary. The brother who is in government servant is not a beneficiary, but mother's will says, my total property goes to my brother. So he'll bequeath it from his mother so that every time he is in a government position, he will not declare these assets as his assets. Is that right? So sometimes when you create, when you make this statement that all are beneficiaries, there are exceptions to the rule depending on the situations. But ultimately ensure that all are beneficiaries. That's the objective clearly. So sub-trust, sub-family trust can be created, 1 or more family members. We are also creating sub-family trusts. See, there are various cultures in our Indian society follow various methods when girl child gets married. Some cultures give them out some money and then that's all they are done at the time of marriage. Some cultures, Supreme Court says they have equal rights. Some cultures, they have equal rights all through their life. Some family cultures follow a system where they give them some ad hoc amounts they settle at the particular point of time. Some cultures create a separate trust, put the property in the girl's name, and manage it for themselves so that the in-laws house don't have access to that wealth in case of any emergency. And in case of any problem, the wealth is not gone and being begged, and it is within our hands. So the various forms. So sometimes sub-trust is also created for the girl children whenever they get married, if they are continuing to be in, or even if they are not going to be enjoying at that particular point of time, they are given something, even that is put in a trust so that that is protecting for that girl and her children. Sometimes that husband is not a beneficiary, only the girl and the children are beneficiaries. It is made that way. Because it is so illogical to do that, a discretionary trust is made where it is not known that the husband is not a beneficiary. Yes. Because he is a son-in-law, is that right? So these are all some subtle things where you play the trick, and then you create a trust and a discretionary trust, and you don't know who is a beneficiary. You know that these, you don't know the proportions. His name is there in the will. His proportion is written as 0 or 0.01%. Is that right? So it's very cleverly done. You put the beneficiaries as 4. Son and let's say two daughters or 2 sons are there. You put the 4 numbers, but then it is a discretionary trust and proportions are not known. So it is not. I'm not saying that this must be done, but these are practiced for these reasons very clearly. So sub-trusts are created. That is one.
Yes.
Yeah. Is there a question? Okay. This I already covered. Yeah. Then I'm coming about a trustee company. I talked about, since Indian trustees have unlimited liability, it's always good to create a trustee company. We have done one of the friend of mine was created a family trust. He's got a family trust. His trustee is a trustee company, and the people sit in the trustee company as directors, like how I sit in a trustee company as directors.
Yeah, the shareholders in that company.
There will be a guarantee company. Generally, a trustee company will not have shareholders. Okay. It will not even have a bank account because you don't do anything in the trustee company. It's just the trustee company will only manage the trust. That's
it manages it, but how does the benefits flow from the company to the?
No, the trustee company. See, let's understand this trustee company very well. In a trust, supposing you and me form a trust. Okay, we are the only 2 trustees in the trust. Okay, then the assets of the trust are generally held in the name of the trustees, because trust is not a legal entity to hold shares or anything. Indian Companies Act does not recognize trust as a legal entity. So if you have to invest in a company, as a trust investor on your name, it will say account XYZ trust, or in my name and say account XYZ trust, depending on what is written in the trust deed as who will hold the investment. Supposing it says jointly will hold all the investment, your name will be first name, my name will be second name in the share certificate, it will show account XYZ trust. Okay. Now, instead of the trustee, you and me being trustee, this company is a trustee. So the company name will be there in the share certificate. Supposing you're investing in Reliance, the company name will be there in the share certificate, account XYZ trust will be there. Is that right? That company. So that company is generally formed as a non-share capital company because nobody is holding. The people who are their trustees, they guarantee for that company, and that company acts as trustee. Generally, in abroad, if you go, the trustee company will not even have bank account, will not have any balance sheet, because it will not do any activity by itself. The activity of the trustee company is only to manage the trust. Is that right? What comes into the trust, what goes out of the trust is what they are signing. Instead of individually you signing, this trustee company is signing. But Indian context, because you have to file a tax return, nil return, some bank account is required, all these complications we have. Today in India, you can't file a tax return without showing a bank account number. So some complications are there. So you go and open a bank account, but it's a dummy account. You put some minimum 1,000 rupees, ever that 1,000 rupees will remain, and you produce a bank statement saying that no transactions are there. Because all that, the trust will pay to the trustees fees, because they are the protectors of the trust. I told you the trust will not deal with anybody other than the members. It will pay a trust in case there is a professional trustee, you pay sitting fees to him, you pay yearly fees to him, professional fees to him, it will pay, because he's a trustee. The trustee can't sue a trust. because it will not be unless he has been deprived of certain benefits which the trust has agreed to give him. Only on that context. Otherwise, he can't sue a trust because he is to protect the trust. Very clear. Family members will act as. It could be a shareholding guarantee company also. Both are possible. So this transfer of assets from individual to trust, so long it's an irrevocable trust, it is exempt from tax. Supposing you create a trust and you have properties, and so long it's an irrevocable. Now we asked about dissolution of the trust. No, so long it's irrevocable, it's exempt from tax. So you don't pay a tax for putting your property. You may pay some registration charge because the registrar, when you go, there is what is the registration charge? It's a fee, administrative fee for the work which the registrar does in changing the records. That's what is the registration fee, no? Yeah. So you pay that because there must be the same percentage. I mean, there is two. There is a stamp duty, there's a registration fee. Stamp duty will not be there because there is no change in the beneficial owner. Only registration fee will be there.
Okay, that's small.
That's a small one. That's okay. Only the registration fee.
That's a fixed amount.
Yeah, that's a fixed amount. Stamp duty will not be there.
Stamp duty will not be there.
Because stamp duty arises, generally by stamp duty arises when there is a beneficial owner change. That is, what is beneficial owner? The actual owner is getting changed. If you are owner of the property, you are putting it to your trust and you are the beneficiary, then there is no change in the beneficial owner. Then stamp duty should not arise by law. That is why your shares held in depository, when you transfer, there is no.
The change is happening to whom? If one owner, if it's a blood relationship, if change, still there is a stamp duty.
So that's where what happens. Supposing, generally when Indian context, when you create companies within the family, within cousins, joint family, yours account there is a white money is there, you put and then create. Is that right? It's always very haphazard, no?
Okay.
Even though one third, three brothers are there, it will not be in that proportion always. So but it's always good to create some gifting structures because you can today gift without tax. We will also work out direct and indirect methods of gift. Sometimes I will give to, now if I have to give to Venu, I may not be able to give to Venu. I will give to my brother will give to Pushpa, who is Venu's wife, and then Pushpa will give to Venu. I can give to my brother is exempt. I can't give to Venu. Venu is my brother's son-in-law, so that Income Tax Act does not provide that comfort. So a three-way structure we have to go through. Now then, Venu and I have to become 50-50, we do this. I had 100% or 99%, I do that. That's how we do it. So that when you create a irrevocable structure, it's always good to be, so that you avoid all future disputes completely. No need of any assets, So we go through this process of normalizing the holding structure and then ensuring that properties are put in the trust. It's always a good way to do it. So you avoid any kind of disputes.
So now, small question.
Yeah.
Let's say my father is creating a trust, and me, my brother, we have four properties on our name, and then so we gift it to our dad, and then we put it in the trust.
Possible.
That's how.
Possible.
Then
he puts both of you as. But if these two properties, one property is worth 100 crore, other property is only 10 crore, then you will create. Your father will create a trust. You'll create a sub trust. You'll put your properties in that sub trust.
Yeah.
Your brother will put his properties in the sub trust.
So, but if you're on the same page.
If you're on the same page, that's what is it. That's why where his question all the answering simultaneously. Because when you have properties, one could be 100 crore, one could be 10 crore.
Okay.
Is that right?
Sometimes family totally, he should not go simply down.
So a lot of families today are in the family constitution thinking about equality.
Right.
Because too much of disputes are happening in the family only because of variation of wealth and status.
So only the author gets an exemption for putting his assets in the trust, or all the trustees also get an exemption for putting?
The trustees are just like board of directors. The author and the beneficiaries.
Yeah, the beneficiaries. I mean, the beneficiaries. Suppose I'm creating a trust with me, my wife, and my son.
Your family wealth will be put into the trust.
Yeah.
Your family wealth.
There are certain assets. I put it to the trust because they are on my name. There are certain assets my wife will put into the trust because it's on. So all of these are exempt from stamp duty.
Otherwise, also I told you. Now I told you, I'll give an example. Your wife can gift.
But again, there is a 2.5% stamp duty there for gifting.
Gift stamp duty on immovable property or talking
about. On immovable property.
Immovable property.
Yeah.
Yeah. So You can also, your wife can put the into a separate trust. For a product, we can merge both the trust also. We can dissolve this trust into this trust. It's also possible. A lot of people do that also to avoid sometimes stamp duty. It's not. It is not that it is not possible. It is not easily possible also, but there are possibilities. We do sometimes like that in the eyes of law, which is legal. Sometimes what happens, stamp duty is always at the point of incidence. Even in trust, why trust is always created only 1,000 rupees? Because if you create a trust with a big property, the stamp duty is paid on the total value of the trust. When you create a trust with 1,000 rupees, then put the property in, it's very different. So stamp duty is always the incidence of a transaction happening. Sometimes we'll pick the incidents to happen later or before or at the time. All these are a planning vehicle and tool. And you must transfer all the trust. So when you create a family trust, you may do a lot of businesses, right? Your existing business. We profile businesses based on risk, based on joint ventures, based on your own business, and what kind of disputes are possible. Supposing, let's say, you have a family trust. Let's say 2 brothers are there, and there are 2 different. One is into some solar business, other one is into some copper business. Suddenly 3 years copper is doing very well. Suddenly 5 years solar is doing very well. So, and each of them are managing that business. I take the Navin Jindal and Sajjan Jindal case I told you. Steel is doing very well for 5 years, sometimes it is down. So, that's kind of a situation. What happens? You also profile sub-trust in such a way that some liability of one business is not flowing onto other business or other trust, which is lucrative. You also want to secure, is that right? So that while family is doing all this business, each business got its own risk. Let's secure that business. So you might create sub-business trust. Under that, you will have a vehicle, a special purpose vehicle holding the investment, and that will hold. So that the corporate wheel stops at that point, never goes to the main trust. And generally, when you create trust, we tell people don't give personal guarantee. Because giving personal guarantee, the lot of purpose is also lost. So slowly you have to get out of it. So we also do what you do. We also put certain properties only in that trust, which you can give as a collateral. So only that part of the property is always at stake. Not every property is at stake. Again, why a sub-trust is done. You got 10 landed properties. You put 5 properties in one trust. Tell banker boss, I have got all these properties, I'll give you this as collateral. You are restricting other 5, you are keeping it safe for you, right? So why we do a sub-trust is umpteen reasons, which we do a customized one-on-one dialogue to understand. And then customize it depending on risk profiling, depending on past debacles in the family, business risk, how much you are geared, how much cash you have got, and how well the equation in the family is. There are hundreds of reasons. I can't put a straight checklist and tick it off. So the new investments, we always try to structure separately. Initially, when you do investments, see, generally a trust, the trust is there first. Under that, there could be sub-trust or there may not be sub-trust. Under the trust, there is an investment vehicle. It could be an LLP, but trust can't be a member in LLP. If you are a trustee company, the company can be a member in LLP on behalf of the trust, but there is a small controversy about it. A lot of people structure pure partnerships as the investment vehicle. So there will be a trust, there will be a partnership because partners, the trust is a partner in a partnership and somebody else is having a small 0.01%. So that as a partner, you can draw the money from the trust, that the money can go to the trust. Sometimes we don't flow the money to the trust if you want to invest. A lot of trusts have permanent capital, which they want to insulate as the minimum. It's like how we have reserve reorder level and reserve stocks level in factories. Yeah. The permanent capital is a reserve capital. That's a red line capital. We can't go below that. That much amount is always put in the main trust. Supposing my family says, my New Zealand family I trust, we have got a permanent capital. We can't go below that. So that amount is put only in government treasury bonds, nothing else. It will give 1% return, 0% return, minus 1% return, that is put only in that. So that's my reserve capital. I should be able to get that at any point of time without any risk. without any solvency of that money being lost. I can't take any risk on that capital. So I'll move money as my family keeps becoming more, as my family lifestyle. I mean, when you say, when you go to your trust, your family lifestyle is not to be more spending more, but to have more quality of life. Is that right? I sleep in a normal bed. I want to sleep in a better bed, which probably has some muscle formation issues not being there. When that bed costs 10,000 rupees more, or 1 lakh more, or 10 lakhs more, I want to buy that bed. It's a quality of life I want to go through. So I take care of it as a minimum reserve capital in the main trust. Then when I get a property, when I sell a property, when I get my returns, I will move some amount to the main capital or keep it here so that I can do wealth management. The money here is done for wealth management. The money here is kept more as reserve capital. That is also invested, but invested very low return, not with the objective of return. That objective is preservance. Is that right? So that return 1%, 2%, 6%, 5% will keep growing. But this is growing at 18%, 22%, 24%, 36%, whatever percentage it is. So that is so the whole wealth is a combination of all this is the wealth management what you do. So that's a preservance capital, is a growth capital. In the growth capital, the family might decide something as a risk capital. Okay, I will take this risk. This I will invest only in safe bets. This I will invest in risk. So your capital is also bucketed very clearly with return in mind, with risk in mind, and what I can afford to lose. A lot of trust internally they will evolve as a trustees. Okay, we will never put this is called as VAR, value at risk. We will never take more than 20% VAR, or more than 30% VAR, more than 40% VAR, more than 50% VAR. Could be any percentage, depending on which market you are in. If you are in the stock market, okay, let me take risk for 25% or 30% or 40%. Without risk, I can't make money. Is that right? Risk and return are very linked. So those kind of norms are fixed. Accordingly, the family office gets created, that much wealth is created, then asset allocation is clearly done. Asset allocation is clearly allocating money for each type of asset. This much I will put in mutual fund, this much I will put in equity, this much I will put in maybe some real estate, this much I will put in some annuities, this much I will put in buying some exotic old wine which I can sell after 20 years. So long-term investment I'm making. Is that right? So like that, asset allocation is made, and those allocations are followed scrupulously. The family office takes care of that. Is that okay? So I broadly covered the entire structure. I don't know how much time we have. I don't know how much time. 1 hour?
1 hour.
Yeah. So we can have a free flow of question answers. I mean, I may not have covered certain nitty-gritties of it, but this is in a broad context to set the opening mindset, and then to build upon it.
The investment in the trust they make money. What rate are the tax? Like your tax
if it's a beneficiary defined trust, the individuals get trust.
Highest.
The individual, whatever rate you are, there's no change in tax rate. If you are, as if you earn the income individually, same rate. There's no change. You are neither, you are not in a disadvantageous position. What I mean is,
if I as an individual create a trust in another country, let's say UAE, where the tax rate is 0 for resident, but I am an Indian citizen, I push my money there. Can I use that trust to make money there and keep it there?
You see, as India, as a global citizen, you are taxed. Right?
Yeah.
Sorry, the global income is taxed.
Right.
That right? So whenever in the 80s and 90s, when Indians migrated, Andhra, so many people migrated to US for jobs, that and they had a lot of properties. So we used to put their India properties into a trust, so that when they declare their income, they did not declare it in the US, because there is earning rent and all. Right. Because they became permanent citizens there, and the global income is taxed. So we planned in such a way that they need not declare it, because an independent entity, you are the beneficiary. Only on distribution he has to do, so we never distributed. So similar way, India so far has not got a rule saying that if you are holding money abroad, even if it is not distributed, it will be taxed. But that rule is soon going to come. It will be included as if you have got distributed. When you got a distributing capability and you're not distributed, then it will be deemed that you are not.
That's a trust is not made.
But you are the beneficiary, is that right? All the beneficiaries.
Make a trust, let's say to give to my nephew, for example.
You put somebody as a beneficiary, it's fine.
Then, let's say I move in, say 10 crores to Dubai, and I move in some other.
Then you are alienating. The moment he becomes beneficiary, you are answer.
But he's again an individual.
Then you will pay tax for it. That's a different story.
So when it is.
As of now, when distribution comes in, he pays tax.
Okay.
But see, tax is evolving. Is that right?
Mm-hmm.
And we are evolving because there are too many millionaires who have become in this country. So obviously, tax will evolve. And when you become a millionaire, you have too many friends abroad. You create too many structures abroad. Is that right? That's how the system grows.
Right.
So obviously, these things will come.
So right now it's a little gray.
It's like, right now it is not there, but it's soon likely to come. Maybe in the next budget or the next budget is my guess. Maybe mostly the next budget is my guess.
If this government is
It doesn't matter.
This government is there for next 4 years. Next 4 years is budget.
Tax is.
Sir, I have one last question. What about a child trust? So my CA advised me to make a child trust so that we can start investment in a trust, and the person for whom the trust is created, that is my child, will get the money when he turns 18-year-old. So how does that work, and what is the taxation aspect of this kind of a trust?
So I missed listening to you in the very first part. Can you repeat, please?
Sir, my chartered accountant advised me to open a trust for my child. He's just 2-year-old.
Okay.
So can you please give the taxation aspect of it, or whether it is suggestible to open this kind of a trust?
No. So when you open a trust for your child, the taxation aspect does not change. It is as good as your income, but you get protection. Supposing you put your home for your child, that home gets protected. Unless you are not pledged that home. I mean, if you already pledged that home, you have to take permission from the whomever you have pledged it. But if it is a free home, even if you have liabilities and you are not given that property, amount you put it to your child, you will have a protection. So a lot of times people, when they are into very risky business, they create, as soon as a child is born, they create a trust and put properties on that child name so that for the next 18 years, that property gets protected.
Okay, so the tax to any income of the trust is taxable in the hands of the parent, you're trying to say.
Obviously. Any minor's income is taxed in the hands of the parent, so that will not change. It's not a tax planning tool, it's a security and a protection tool, asset protection tool.
Basically, you're saying that any trust is not any legal entity. A trust is not a legal person.
No, trust is a legal entity for certain purposes of holding shares and all. It is not regarded as legal entity. See, anything which is incorporated under a particular act, Indian Trust Act is an act. It's an old act, 1892 Act. So it's a legal entity. It's a taxable entity, legal entity, all those are there. But Companies Act recognizes certain people as who can be qualified as a member. For trust, it qualifies a trustee as a member, not trust. Because trust is not a legal entity, you can't sue. You can sue a trust, trust can sue somebody, otherwise it will not have the ability to sue, no?
Okay, sir, thank you.
So Vineet, I hope I answered your question about discrimination. Is there any more supplementary questions which you want me to answer?
Everyone's on. This camera.
Basically, when we're talking about 4 or 5 people coming together to form a trust, or is it one person bringing his property and creating a trust, or is it like
there could be multiple authors also?
Multiple authors.
4 or 5 people. All of us can today form a trust, all of us can sign and become authors for the trust.
Authors for the trust. And then when we are talking about that in a family of 5-6 members, all of them come together, form a trust, and bring all their properties to the trust, and it is exempt from stamp duty.
Yeah.
Yes.
So sometimes what happens, I have seen examples, and of course, from the Marwadi community in Rajasthan, I've seen an example where father had only one son, the other side, the girl is only one girl child, both are married. They joined, both the fathers have jointly created a trust where the property is going to only one family. That time through authors, they had substantial property, they had substantial property, both have formed a common trust, two authors.
But it's going to become very prevalent soon in South India. Most people having one claim. It's going to happen very soon.
So that's possible. Because the beneficiaries are the son and daughter, no, nobody else. For the son, for daughter, the same.
Because this was an initiative under this group that we have called wealth creation. Right? So this is something that we have for members, it's called wealth creation. At some point or the other, there will be people in this very group who will want to do some business together. Are trusts a good way of?
No, see, as I told you, we don't do business from the trust. I just told you there is always
No, we don't do business.
a structure below the trust, which does business. Because we want people to, supposing you got your family trust, then there's a partnership created or an LLP created, that you and me are doing joint business, or you and Venu are doing joint business. We'll invest from the LLP, he'll also invest from his LLP company. If at all I am a third party who is coming doing business with you, I can adverse sue the company which both of you created, or adverse sue the shareholders. This your LLP and this LLP I will sue, but I can't sue your trust. Okay, that is invisible to me. The visibility I have is the company which you both have created and the company shareholders. Is that right? That's why we will not do business directly from the trust. It's not a good way to do. You always keep your trust insulated so that you don't deal with third party. That's why I told you in the mother preservance trust, we will never write any check to anybody other than the trustees or the beneficiary. We'll never write. It's forbidden generally. When I am there, I always tell them don't write. Don't involve.
So, but there are some trusts where the property, there's categories of the properties which are part of the trust. One is the protection of a particular property, that till the total board decides what needs to be done for the particular property. And there are certain properties which are generating some rental income. The objective for that income is to benefit some needy people who need sponsors and all stuff. That's where the checks are cut. Or it's recommended, that please sponsor through this trust for that. I think so. There are some benefits in income tax when you do that, right?
Yeah, to the extent, see, income tax has got one section known as diversion of income by overriding title. When you write in your trust that so and so is a beneficiary, to the extent you don't get taxed. And that is charity, and that is governed by charity, and that goes by charity.
Yeah.
Supposing in my trust, I write 10% of my wealth will go to TTD. I will not pay tax for the 10% of my wealth what I generate. It will go as donation to TTD, and that's all. They are anyway exempt from income tax. So to the extent of the 10%, nobody is paying tax.
We've been using a family company like a trust. Right? So my grandfather started the company. When he left, my dad took it over, and I've got that. We've got certain assets in the company, and I'm trying to move it to all financial. How do you remove money from a company? So if I want to put it in the trust, I have to remove money from the company, and
those will be that is a typical dividend. Whatever.
I can't merge the company assets into a trust. And
no.
Even if the trustees are the same.
Okay. Anyway, you will have taxable event.
I will have it.
Any asset stripping in a company, you'll have a taxable event. So you can't do it. You can merge between two companies.
I can't remove the assets from.
I think we need to ask one more question. The other one is discretionary, the other one is financial assets. And okay, you also asked a question. Why do you create? People are saying that create financial assets separately. I mean, See, generally, that's why I told I have created a trust where the preference capital is completely the mother trust. That will never deal with outsiders. That will never invest that money, even in 0.01% risk. But that's the minimum capital for the next generations ahead we are keeping. Is that right? Then there are trusts below where there are financial assets involved. There are annuity income which comes as a regular income for families involved. There are trusts which are being created only for family expenditure. They go on a joint vacation, buy tickets, so that you don't need to provide details to income tax. Your own family trust you are spending. It's like a personal spend, There are only trusts created only for that purpose. In fact, one of the family, we are creating a trust in Dubai where we will be holding money for their family vacation.
Similar to what
So that is, that's the purpose of the trust, is that right? But that amount is also set aside. So when these trusts are created, there is a revenue generated. Some percentage, 8% of that is set aside for this family vacation. So only that goes into the trust. So within that you manage, is that right?
So now, earlier we were talking about the distribution of income to the trustees and then being taxed in the hands of the trustees. Beneficiaries. So if it is
only when it's distributed, it gets
yes. So tomorrow, you say that it is deemed distributed, even if it's not distributed.
And I talked about from abroad.
For abroad, not in India.
India, anyway, you will see if it is not a discretionary trust.
Yeah,
where clearly people will include in their tax. If
it's a discretionary trust, then what happens?
Then the trust will pay tax.
The trust will pay the tax.
The trust is assessed as a assessee and the trust pays tax.
But when the distribution happens to the
then they don't pay tax. They don't pay tax. It's free. It's free. But the trust pays a little higher tax.
Or trust pays a higher
tax. But sometimes you sacrifice. I told you I don't want to put my son-in-law. I want to put him on 1%, and I'll put discretionary.
So what is the rate difference between an individual and
3 and 40?
Any ideas?
3 and 40. Yeah.
interim rate,
Interim
maximum marginal rate.
That is 40%.
30 plus 12 plus 4. 39 plus.
It's not an individual, no? Yeah,
Highest.
Only thing, if you are in the highest slab, it makes no difference. If you are in the lowest slab, it may make a difference.
Most people in that class would be in the slab.
Yeah, any more questions?
I think everybody is mute. So I think
Everybody
it's
is
from
mute.
our side. I think
No,
We have muted.
no, we are not muted anybody.
No, not
We are on the phone.
Yes, sir.
Can you just unmute everybody? So if anybody has any questions,
They've all muted themselves.
Yeah, Kannan.
I think they've already run to make the class.
Yes, Shyam is unmuted now.
John, do you have any questions?
Ragu, so say there are foreign assets, right? So for foreign assets, you have to create a foreign trust. I think, say foreign assets in the US, you have to create a US trust for the same benefit, or they cannot be linked with the trust in India, I guess.
I mean, Indian trust can own property abroad, there's no problem, but it's always wiser to create a trust in individual country so that you restrict. Tomorrow, if there is a claim on you in the US, you'll go to that trust rather than coming to India trust. If you put everything in one trust, you expose yourself, unfortunately.
Yeah.
That's the idea.
Tax complications.
Yeah, it creates complications. It's not easy to execute a cross-border, claim on you. Not so simple.
Right.
There are also jurisdictions for creating trust. If you create a trust in New Zealand, your foreign sourced income in New Zealand trust is not taxed. You can create you have 10 properties in Hyderabad. You can create a trust in New Zealand. Say in the trust deed that this trust will operate under the Indian Trust Act rules, and show all your property income in the New Zealand trust. The New Zealand IRS will not charge you tax on that because it is not an income earned in New Zealand. Some jurisdictions are there like that, which are trust-friendly jurisdictions known as.
But the Indian government will still.
You're earning income in India, property situation you pay, but you don't pay a double tax. But you are creating a trust in New Zealand for certain other purposes, maybe some other advantages sometimes. But generally, I would recommend people in India not to complicate their life, create trust abroad. Sometimes you create trust in New Zealand, trust in Singapore for investment purpose, because Singapore is a good jurisdiction, gives high protection to beneficiaries for certain reasons. But these are all on a very, very business-related reasons. I can't indicate a single reason why we will do, but very many reasons we do.
Recently, a lot of families are creating gift city family offices. Is it advisable? What is the rationale of doing
It's
that?
like creating a Singapore trust.
Singapore or Dubai trust.
Yeah, so that's how it is. So because when you are creating in family cities, in India, you are creating abroad. That's what it is, no? So you don't have restriction of remitting money abroad. I don't have this $250,000 restriction.
But moving to gift, you will have that restriction of 250,000, no?
No, you put in, for that they're given relaxations. First time creating capital because they want to make that gift city vibrant, you know.
Okay, so you can transfer more than 250,000?
I think for gift city, they're given exemptions. I can tell you exact what is amount. But they've been relaxing more and more because they want to make it more and more popular. So you create, but I don't have so many restrictions.
Okay.
In the gift city.
From gift city, you don't have restrictions, but from India to gift city would be.
So if you move money into gift city, let's say you move $1 million instead of 250, and you make money on all that tax, like an FI or what was it?
Gift city provision is not separate taxation.
So if you are investing in Indian equity.
Gift city?
Yeah.
Indian equity will be tricky because it will be round tripping.
Yeah.
So you have Indian equity, you have to invest from India.
Well, what is it?
Gift city is for international investments.
Okay.
So if you treat it as FI,
So you can get into gift city and buy an India-based mutual fund.
no, you buy outside.
I can buy an India-based mutual fund outside. There is a fund which is, let's say, a Dubai-based fund, which invests into India. I can put my money into gift city and buy that fund. I'm again investing into India.
I mean, but still come to the but yeah, you could do that.
If they are taking, they will also do KYC.
Okay.
They are taking, they will also understand that when they are given approval, like I told you, in the mutual fund, we have our own norms, what we can do, what we can't do. We communicate that to the our authorized players. Is that right?
Beyond what people are doing is they're accumulating money in gift city. If you want to buy assets abroad, like properties in Europe or assets in US and all, there that annually what we have that liberalized scheme, right, 2,000 per person per year, that limitation is not in gift city. So I can even
move say 10 million into gift city, buy a hotel abroad, and the hotel next year, then where does the money get taxed?
gift city norms, what are the taxes? It's not the same as the price tax. In first 10 years, they have a tax holiday in gift city. And there's a tax holiday, but there's no GST in the gift city.
No.
So this is also but the tax holiday is only for the first 10 years, right?
That will get separate list. I'll circulate gift city exemption separately. We'll make a list and then that will be useful. That's got a separate regime. There is it could be a separate session because there are a lot of other things on gift city. I mean, it's not linked to this. That's a separate session by itself. It's also got, you can't do many. Gift city has got specific areas only you can do gift city. Not that you can't go and get a pawn shop abroad and then I want to put money in gift city.
Right.
There are permitted activities. Only those are allowed. They keep on adding. They keep on adding new activities. But as of now, there is a list of activities which are permitted to be operated from there for the purpose.
Thank you so much for doing this for us.
My pleasure.
Yeah, thank you.
I'm sure this will open up a couple of very interesting thought process for us.
Talks also, I like your work and
No, I was wondering whether he knows what he's getting out of
Thank you so much, Mr. Ragu, for your time.
Thank you. Thank you.
Thanks, Chandrika. Bye.
Pleasure was mine.
Thank you. Bye-bye.
Bye.